Hello and welcome to this very special conversation with Nilesh Shah, who's the Managing Director at Kotak Mutual Fund. He's also the Chairman of AMFI and a member of the Prime Minister's Economic Advisory Council. Thank you very much, Nilesh, for joining me today in these very difficult times. Thank you for taking time out to speak to our viewers. My first question to you is that while the first wave we saw a very sharp fall in the markets, the second wave, which is far more severe, we seem to be experiencing the markets holding up so far. Why do you think that is happening?
So, despite very challenging times currently, market is hoping that with vaccination, we will be able to control COVID-19. Market is also pricing in that a national lockdown will be avoided. People will follow COVID appropriate behavior, and hence with regional lockdown, with rotational lockdown, we will be able to overcome COVID-19 crisis with minimum economic disruption. So this is the hope, and also the past experience where in panic people sold in the month of March all the way up to 7,500 Nifty and realized that they were panicking unnecessarily. So there is part experience, part hope, and the faith that vaccination will overcome COVID-19 crisis, which is keeping market where it is today.
Nilesh, you've always kept a very strong pulse on retail investor behavior. So let me ask you, how are retail investors behaving? Are you seeing inflows? We saw a good number coming in last month, but how are retail flows going at this point of time?
So obviously there is a segment of retail investors for whom right now priority is to take care of their relatives and near and dear ones. Financials or investments obviously take a backseat for them at this point of time. But if we look at overall investor community, they have used this correction as an opportunity to increase their allocation to equity. Number of SIPs are going up. SIP contribution is also going up. Equity flows have also turned positive since March, and despite very challenging time currently, it continues to remain positive as we speak.
Nilesh, in your early part of your career, you focused a lot on the debt markets. So let me ask you this question while we all talk a lot about equity markets from a retail investor perspective. But what are the kind of debt returns that investors can hope for in the coming months and a year?
So Vivek, by interest rates have come down, and in this kind of economic environment, they are likely to remain low. They will rise marginally, but not by a big margin. And hence debt investors will have to be geared for lower return on their portfolio. My recommendation to investors will be to look at credit risk fund. They have got a bad name in last 1 year because of a couple of schemes going for winding down. But if you see the return of credit risk fund over last 3 years, 5 years, it is still reasonably good. If your risk profile does not permit you to invest in credit risk fund, please consider dynamic bond fund. The returns fluctuate, but over a period of time, a good fund manager delivers good return by managing interest rate risk. My general recommendation to debt investors will be that you won't be able to outperform inflation by remaining invested in debt. You'll have to take some risk. Either it's a credit risk in credit risk fund, or it's interest rate risk in dynamic bond fund, or it is equity risk in hybrid funds like balance advantage fund, balance fund, or conservative debt hybrid scheme. My recommendation to debt investors will be also consider REITs and InvITs. These are again hybrid instruments, and they can still deliver probably somewhere around higher single digit to lower double digit return, albeit with some volatility.
Nilesh, one trend which we've seen playing out over the last 1 year is increasingly a lot of retail investors seem to be going the direct route to buy stocks rather than coming through the mutual fund route. Uh, Data shows that. How do you read this trend, and what would be your advice to retail investors?
It's a very encouraging trend. We believe any person who has entered into stock market on a direct basis is potential mutual fund customer over a period of time. Many investors will realize that direct investment is not their cup of tea and they need professional help, and hence will come to mutual funds. Many investors will learn from direct investment in stock and complement their portfolio with mutual fund investment. At the end of the day, Vivek bhai, we have to expand the pie, and any person making direct investment in equity will eventually become a mutual fund customer.
Nilesh, you've been a great votary. In fact, even a few days ago, you tweeted about gold and, gold imports and the huge amount that we import as a society, physical gold. And you've been talking about how we need to divert this consumption into financial markets. What, according to you, can the government do to boost this?
So essentially, Vivek bhai, if you look at our financial market entry norms and continuity norms, they are really, really harsh compared to buying gold. If I want to buy gold right now, I just have to walk into a jeweler shop, pay the money and take gold back. There's no need for KYC. There's nothing called dormancy. There's nothing called re-KYC. Now, unless until we make financial investment as simple as walking into a jeweler shop and buying by making payment, financial markets cannot become deeper. Financial markets cannot penetrate retail investors. So we have to focus on creating, like Aadhaar, one single KYC across entire financial market. Today, your bank KYC is not good enough for mutual fund KYC. In a bank, one bank's KYC is not good enough for another bank. Within one bank, one branch KYC is not good enough for another branch. Within same branch, one bank account's KYC is not good enough for another bank account. Now, these are all maze which we have created to confuse investors so that he doesn't enter financial market. Now, these are all complications. These are all deterrents for retail investors. They want as simple a thing as walk into jeweler shop, make the payment and take the gold and come home. Unless until we make financial instruments as simple and as easy as buying gold, there's no way we can replace gold.
Nilesh, what are your fund managers telling you at this point? What are the sectors that they seem bullish on or they find attractive from a 3 to 5 year kind of a time frame?
So one sector where we as a fund house are bullish is home improvement. Now with vaccination, when economy opens up, most of us are going to spend some money on improving our home. And all the sectors which are linked to home improvement will have a good time. Whether it's cement, plywood, tiles, paints, furniture fittings, electrical appliances, electrical fittings, consumer durables, all these sectors which are linked with home improvement will see tremendous volume growth after vaccination is successful. And that sector, home improvement, should deliver better return to investors as volume and margins will be ahead of investors' expectations right now.
Nilesh, recent data that I was looking at seems to suggest that less than 10% of SIP accounts are held for 5 years or more. And I'm sure you know this data better than what we've read. But how important, according to you, therefore, is it to inculcate the habit of long-term investing? This clearly reflects that we enter, we spend a year or two, and then we exit. Does that disappoint you? And what would be your advice on the importance of long-term investing that you would like to give to our viewers?
So Vivek bhai, my advice to every distributor is that you must carry your statement of account of 15-year SIP, 20-year SIP to the client to convince them to invest into SIP on the long term. If I am not able to show 10-year, 15-year, 20-year SIP return to my investor, how can I expect them to invest with me for that period? Same way, the entire mutual fund distribution community has to show their own SIP returns of 5, 10, 15, 20 years to their clients so that they get convinced about SIPs. And we really feel sad today when I look at my equity funds SIP across time periods 1 year, 3 year, 5 year, 7 year, 10 year, 15 year, we have delivered almost double digit return. And in most of the time periods, we have delivered alpha over benchmark index. But when I look at my 30 lakh investor base, how many of them have benefited in this double digit SIP returns? Very few. So we all have to make a conscious effort, and in order to convince people to do long-term SIP, we need to show our own long-term SIP portfolio.
It's been a pleasure talking to you, Nilesh. Thank you very much once again for joining us in these very difficult times. Hope you stay safe and hope we see better days ahead. Thank you very much.